Today, the credit impulse under the microscope. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Today I want to look at the latest Australian Bureau of Statistics data, which came out a couple of days ago. This is the Lending to Household and Business series. And this is the new series that the ABS has started generating. And frankly, I'm still getting my head around all the data series because all the tables are somewhat different from what we're used to. That said, I've been rebuilding my models and I'm able to explore some of the most critical elements within the data series. And I want to focus in on what's called the credit impulse, which is effectively the rate of change of new credit. Now, this series shows you the flows of new loans. And so it is the best indicator of what's really happening within the marketplace. So to do that, I'm going to look at three series of data today. The first relates to the overall lending flows. The second relates to first-time buyers. And the third relates to new investor loan flows. And as you will see as we get into the detail, there are some quite interesting trends, and specifically the annual trends and the monthly or quarterly trends are not necessarily pointing in the same direction. Now, this is one reason why some commentators are now claiming that the decline in credit growth, and therefore home prices, is coming to an end. Well, we'll see. I'm not quite so sure based on the analysis that I've done. But I'll show you the data, and then you can decide. Now, I'm going to start with the new loan flows to March 2019 in trend annual terms. I should say that we always use the trend series because it tends to iron out some of the bumps on a month-to-month basis. New owner-occupied loan flows are 13.4% lower than a year ago. Investment loans are 22.1% lower than this time last year, and you can see how they've declined from 2017 onwards. Personal credit, in other words, the credit cards and personal loans, is down 14.8%. And overall household borrowing, therefore, is down 15.7% over the last year and continues to decline. For completeness, business credit was down 1.6%, and you can see how it's been declining since September 2018. Leases is down 4.1%. And so the total credit impulse, if you like, is down 9.1% over the last year. In fact, you can see that it was August, September last year that was the peak. And since then, it's been going steadily down. Now, because the rate of change of credit fundamentally drives things like home prices, this suggests home prices are likely to continue to fall ahead. But now let's look at the same data, but on a monthly trend basis now. And here you can see that owner-occupied lending fell 0.8% last month. And that's up a bit from its 2% drop in November and December last year. So the rate of decline is easing just a little. The same is also true for investment lending. It's down 2.2% this month, but it was nearly 3% down in January. So again, a slight decline in the rate of fall, but it's still falling. And personal credit was down 1.3%. Again, that's slightly less than in February. And so overall household credit is down 1.2%. And you can see that the rate of fall is somewhat lower than in November and December last year, where it was down 2% in a month. Business credit, though, was down 2%. And it seems to me that the rate of fall is increasing. Leasing goes the other way, but then leasing is a relatively small proportion of total borrowing. And so the total on a trend monthly basis of all credit is down 1.6%. And you can see that 1.6 is just slightly above the worst case of around 2% in December and January. But some of that, of course, is also to do with Christmas and New Year and the easing around that. So there may be a slight glimmer of hope in that the rate of decline is easing just a little, especially around households, but it's really hard to draw much conclusion from it. Certainly not enough to say that the credit impulse is easing. Now let's look at new investor mortgages written to March 2019 in trend annual flow terms. The reason I've looked at this particular series is because I've stripped out the refinancing of existing loans. And you can see that in New South Wales, the value of new investment loans fell over the last year by 26.6%. In Victoria, it was just slightly above that, but still in strongly negative territory. In Queensland, it was a little bit above that, but trending down. Whereas in South Australia, the falls are lower and it's trending up a little. Western Australia is quite interesting in that the fall was 21.7% over the last year, but that is a little bit of an improvement on what we saw in November and December last year. In Tasmania, there was a fall of 13.8%, and we can see a clear trend down since June 2018. And in the Northern Territories, the flows were down 32.3%, and that's a very low number. But of course, it's worth making the point that the Northern Territory data is quite small, and therefore movements will tend to be exaggerated. And in the ACT, we're just under 20% down from a year ago. In total, across Australia, new investor mortgage loans to March 2019 in trend annual terms fell 25.4%. And you can see there that the trend is still pointing down. Now let's look at the same data on a quarterly basis. And here, the story is just a little different insofar that in New South Wales, new investor mortgage loans did rise a little, or to be more precise, the rate of decline has eased slightly to -5% over the quarter, compared with -7% in November and December 2018. Victoria is somewhat similar shape, similar trend, as is Queensland. And interestingly, Queensland has a more exaggerated slope insofar that they reached a peak back in May 2018 and 19, dipped significantly through November, December, and is rising just a little. South Australia is still in negative territory, but is off -5 in January 2019 to be closer to -3 now. Whereas in Western Australia, there's been quite a significant swing, still in negative territory, down 1.5%, but considerably improved from the November-December drop. But it's also worth noting that in March and April in 2018, the drop was 10%. In Tasmania, it's down 3.8% over the last quarter and has risen a little, but is still in negative territory. Whilst in the Northern Territories, it's down 11.4% and seems to be languishing at an extremely low level. The ACT is about 3% down, still in negative territory, but just trending towards a slightly lower level of falls compared with a couple of months ago. And so the total is down 4.7% over the last quarter, and you can see that since December and January, things have improved just a little. We were around 7% down, now we're at 4.7% down, but just to be clear, total new loans are still in negative territory. So the credit impulse is still easing, it's just that the rate of decline is slowing up. Now let's look at the number of new first-time buyer loans to March 2019. We'll start with the trend annual series. And here you can see that in New South Wales, it's well below the zero, closer to down 10% over the last 12 months. Victoria is somewhat similar, just a little higher than New South Wales, but still in negative territory. Queensland is down 16.6%, And you can see the trend down from June 2017 onwards. South Australia is in positive territory, and that's about 9% higher than this time last year. Western Australia is down 4.5% and has been in that range for the last few months, having been closer to 19 or 18% back in June and July 2018. Tasmania is strongly in positive territory. It was more than 20% if you look at July and August last year, but is now down to 4.1% and is trending lower, but still in positive territory. And the Northern Territories are up 14.8%, having reached nearly 20% in December last year. But again, a small number of properties are involved, so that is quite a noisy series. And the ACT, well, this really surprised me, is down 31.5% compared with a year ago. And of course, if you go back to 2017, they had very, very high numbers. But that has all changed now. So the average number of new first-time buyer loans to March 2019 is down 10.4% over the last year. And that might give you some inkling as to why first-time buyer incentives are very much in the news at the moment. And now I'm going to look finally at the same data on a trend monthly basis. And here you can see that in New South Wales we're still in negative territory just, whereas in Victoria there's been just a very, very slight increase in the number of first-time buyer loans last month. Queensland is down 0.8% and is trending perhaps a little but still in negative territory. South Australia is also in negative territory just, and Western Australia was down 0.7% and has continued a trend that we've seen for the last 3 or 4 months. Tasmania is down 2.6%, and you can see that the fall was quite steep from July and August last year, reached the bottom of the curve in January, and is now moving a little higher but still in negative territory. The Northern Territories were down 2.8%, and you can see there that there was a bit of a peak last year, but it's been falling away in the last month or two. And the ACT is down 7% in the last month, and was quite a lot higher in August and September last year, and has fallen quite quickly since then. So the total number of new first-time buyers to March 2019 in trend monthly terms fell 0.8%. And you can see that there's a very, very slight improvement, but still in negative territory, which suggests that the total number of first-time buyers coming into the market will continue to be in negative territory for some time to come. So I think there are probably 3 things that's worth saying. The first is that clearly there's a difference between the annual data and the monthly or quarterly data. And it's interesting that some of those commentators who are talking about the market in recovery mode is concentrating on those near-term numbers, the quarterly or monthly data. But as you see, the movements up are relatively small, and in most cases, it's a movement up still in negative territory. In other words, the rate of decline is slowing. It's not growing. It's just that the rate of decline is easing just a tad, but really hardly enough to make much difference. Second point to make is that clearly it's the investment side of the ledger where a lot of the issues are. And we need to consider whether anything has fundamentally changed, bearing in mind that lenders are still very tight with regard to lending for investment purposes. We know that many investors are switching from interest only to principal and interest, and that's going to create a significant issue. And we know that rental returns are continuing to dive, partly as a result of lower rents and also degraded capital returns. And the third point I want to make is that you can almost build whatever story you want from the data, because of course the data is subject to your own interpretation, which will in turn be driven by your own worldview and your own perspective as to what you think you want to see. So what I've tried to do by presenting both the annual data and the nearer term data is to give you the chance to make your own view. What do you think? Do leave a comment below. Tell me whether you interpret this data as showing continued falls or whether in fact this is the start of a recovery. And remember, this is so important because the rate of change in the credit impulse directly translates into lower or higher home prices. My current modelling, which we're going to discuss next Tuesday on the live stream, here's a link to the event if you want to bookmark it, is that we are seeing the credit momentum continuing to ease. And therefore my modelling is still indicating more home price falls ahead. But the bottom line is this: credit momentum is still very weak. And that's why we're seeing so many calls from the property sector and elsewhere to loosen lending standards and increase the credit momentum, because that is the only game in town to force house prices up. But as we discussed the other day, that will be a mistake, because from a housing affordability perspective, home prices are still way off whack. And in fact, if we're to deal with the long-term issues in the sector, then property prices have got to continue to fall for some time yet. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.